Last week, I watched the stock run 187%, but I watched from the sidelines. Not because I couldn't see a setup, but I knew something others didn't. One number told me this stock would be a nightmare to trade. Most beginners would think I'm crazy for passing up a stock that moved 187% in 45 minutes. But here's what they don't get is that's normal for day trading. That's actually very slow. And there's one key difference to why some move quick and some don't. And today, we're going to find that out. So you'll learn the one number that separates explosive stocks from grinders, how to spot it instantly, and how to avoid getting stuck in slow trades that waste time and increase risk. So what is this number called? It's called float. That is the number of shares available for the public to trade. Think of it as the supply part of supply and demand. So when I'm trading, I focus on a number that's under 10 million shares. That's kind of the magic zone. Anything above that, that's when things start to slow down. Think of it this way. If there are only 5 million shares and everyone wants in, the price skyrockets because the supply is limited, but the demand is high. Now, if you take a large cap company like Apple, for example, with billions of shares available to trade, even with a ton of buying, the stock is just going to crawl. So what stock am I talking about that went 187%? Well, the stock was a specific stock from last week, and let's hop over and take a look at it. So this stock, GLUE, Glue, it was on our scanners last week, and it ended up peaking about 187%. So where do you actually find the float? Well, on my software here, which is called Daytrade Dash, made by Ross Cameron, fantastic software. It is right here. The float, but it's also on free websites like Yahoo Finance, on FinViz screeners. It could be on your broker's platform. Webull, I know they have it on there. It varies slightly from platform to platform. And you can also go into the SEC filings on a website like BAMSEC and look for the shares available to trade. Point is, it's everywhere once you know where to look. And that is one of the first things I look at before I enter a trade. So when we talk about the move that happened last week that went up 187%, the stock is Glue. And if you look at it, it's a nice looking chart. It moved well. But when it hit the scanners, I think it was on a Tuesday morning, I knew I wasn't going to trade it. And regardless if this went from 5 to a million, I probably wouldn't have taken a trade. Obviously, if it went up to maybe $50 a share, that's probably just too expensive for me to even want to trade. So probably it could have gone up to 200 and I don't think I would have taken a trade on it. But the first thing I see is the float. The float is 45 million shares. And we got a nice move on it. It went from $5 to $9.15. So it was a good move. But the thing is it's a grinder. So when you have a lot of supply, what happens is you need to have more and more and more and more demand to be able to meet that level of supply. So for example, in a stock like this that has 45 million shares of supply and you have 45 million shares of volume, that's a 1-to-1 ratio. But if you take a stock that has 45 million shares of volume, but a 1 million share float, that is 45 times more demand than supply. So that's called float rotation. So what happens is people are buying and selling, buying and selling, buying and selling, and that forces bigger and more drastic moves in the asset. And as a momentum day trader, that's what I want. I want volatility because that is how we make money. And yes, the downside of a lower float is there's higher risk because there's less supply. So that means less volume can move the stock more. But that is a risk that I am comfortable with because before I even make a trade, I am figuring out what I am risking. So I'm taking more control into my own power to figure out what my risk is. So here's how float plays out in real time. When you pull up a high float stock like Ford that is meant to just go sideways, you're going to see a lot of buyers and a lot of sellers on the level 2. So for large liquidity plays from big prop firm traders, hedge funds, that is good for them because they can buy a lot and they can sell a lot and they can move in and out very easily. Now, for us day traders, we don't like that. I can't get in a stock at $7 and sell it at $7 and make money. So what I'm looking for is less supply. So a low float stock. Now, if we take a look at a screen share, I'm recording on a Saturday. I would like to pull up the level 2, but since it's a Saturday, I can't. Blame my work for that. But let's take a look at a low float stock. So AGMH up 356%, and it's actually off the peak. But 205 million shares of volume. We do some math here. Quick math on the calculator. $205 million divided by 1.99. Oh man, good job, Zach. That is roughly 107% float rotation. So there is a lot of demand and a limited supply. So this is how we get bigger movers in the market, the correlation between supply and demand. So that is why I avoided traded glue at the beginning of this week, because I knew with a higher float stock, we would need so much more demand to get it to move a good amount. It did move 187%, which is a good move, but it's very little to what we see consistently in the small cap market. So why does low float matter? Almost every day, the biggest gappers in the market are lower float stocks. It's not luck. It's not by chance. It's supply and demand. There's news and there's not enough shares. So if there's less volume, any buying will move the stock even further up. There will be a bigger exaggeration in that move. So there's less sellers, and that causes to go even more and more. That's where you see these big moves. Now, a higher float stock, you can still get these moves, but they're going to be smaller. And there's going to be a lot more people buying, but there's also a lot more people selling. So everything becomes compressed and in a smaller range. So these lower float stocks, they can give you the volatility to get 20, 30, 40, 100% in 2 minutes, which is stuff I am looking to trade. So there you have it. The number that predicts whether a stock is going to explode or if it's just going to crawl. The float is a very important factor, and I'm always looking for floats under 10 million. Under 5 million is even better. The lower, the better. But obviously, we have to think about our risk because we are traders. We are not gamblers. Risk, risk, risk. The lower the float, the higher the risk. So you have to take that into your control and determine before you even enter any trade, what are you risking and what are you standing to gain? That is trading. Float is just one piece of the puzzle to become a profitable trader. Physically, by the money I bring in from trading, I'm not quite there to profitable, but mentally, that is where I'm working to be, because the mental game is how you master trading. If you want to follow along, learn as I learn, and grow, hit subscribe. Don't forget to like, and I'm going to share everything there is about trading that I'm going through. The good, the bad, every lesson that comes with it, and I'm going to be as transparent as possible. So thank you guys for watching. Hit the like button. Don't forget to subscribe, and we'll see you Monday for a recap. Peace.